Welcome to the September 14th, 2020 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, President, McGowan Group, and your financial weatherman with your fast-paced tour of the global financial markets here at NetWorth Radio McGowan Group YouTube. So if you type in youtube.com, then punch in McGowan Group, will come right up, and you can subscribe for fast-breaking news updates. We were, in the pandemic, talking about the fastest recovery in history as we were dissecting what was going on in March. I'm going to show you how things have changed. The title of this week's program at networthradio.com, with more research and a more extensive exploration, title of this week's program, "Is this recession over?" And we've got some evidence here that I want to go through as we start to see changes in the perspective of the financial markets. So here we go. This is the Dow 3-year. This is the pandemic, the 38% decline in the Dow, the fastest 38% decline in its history. Here's the recovery, and then there was a sell-off from 29.2 all the way down to as low as about 27,000. The NASDAQ corrected at 12%, which is a big topic. So we ask, what's next? Well, let's look at the recovery with some real data. You've heard about jobs, job losses, and we're going to cover some of the real numbers involved in the current recovery. 1 million jobs added to the job openings. These are jobs posted to be filled. It's an official number, and it's also a very clean research number. Now we've got 6.6 million jobs available to be filled. And what's that equivalent to? Well, it's actually not that distant from where we were in December. It's about the same number. And we added 1 million last month. 6.6 million jobs waiting to be filled. How many jobs do we need to get back to a record employment economy? This number is the purest number on jobs we've been able to find. And the headlines that we go through usually go one way or the other, but they don't give a clear picture. 159 million people were employed here in the United States. Total employment in the labor force. It fell tragically to 133 million. That's a loss of 26 million. Now we're at 147 million after this first 3 to 4 months of recovery from the shutdown. 147 million from 159 means that we have 12 million more jobs to get back there. The rate of increase was about 5 million, about 3 million, about 1.5 million. You can see that number of net new jobs added, people coming back into the workforce, it's getting smaller. So if you said, how long does it take? Well, let's say it averages 500,000 a month, not 1.5 million or 5. On a good trajectory, it takes about 2 years to give 12 million jobs if you add 500,000 a month. And that says record employment potentially during 2022. That tells you, yes, we're on a recovery path. No, it's not a recession anymore. What happens next? Well, let's look at money flows and some of the other choices out here. This is one choice that may be the wrong choice. This is the Dow, and we'll just call it U.S. equity indexes like the S&P and the Dow. For 12 years, from the year 2000, tech wreck, the 2008 crisis, through near the beginning of 2012, the Dow did not make progress. That's called a range-bound market. You can see it did make a new high before the crash here, but it was 12 years of essentially zero return or only the cash flow dividend for the Dow, which was between 1 and 2%. So that was an unacceptable portfolio choice, just a pure index. If the equity indexes, and I'm about to show you why, are likely to be range bound for an extended period, then how do we get returns? That's part of what we're going to explore right now. Here, let's look at money flows right now. This is year to date. This is posted at networthradio.com, by the way. Urge you to go there. You can also set your time to come down, meet the team that cares. If you're a client, get an updated plan. We've got safe operations, a free temperature check, free face masks, and free personalized hand sanitizers. But anyway, Dow, $27 billion has flowed out of the main exchange-traded fund that is the S&P 500. The energy sector has turned positive in money flows, which is a surprising change that we've seen. Energy sector actually getting positive money flow. Here we've got the technology, and technology had $12 billion come in, 15 over the last year, but that turned negative, and the NASDAQ went down over 10%. One thing that's happened, COVID immunity in tech companies like a Microsoft or the 12 leaders in the S&P 500, money was flowing nowhere except primarily just the index for technology or those 12 primary companies. That trade cracked and the NASDAQ dropped by about 10%. The money flow turned negative. Is that the beginning of a tech correction? Well, that's what set off that 12 years of range-bound market that I talked about. How did we succeed during that time? Well, cash flow, good gains, and the right fixed income, along with a dividend equity strategy. So, the healthcare sector, positive year-to-date money flow, and that sector had just hit a new high after a bear market cycle. The healthcare sector being one of the favored areas. What is also favored? The high yield strategy, actually getting positive money flow. The Vanguard Total Bond Market represents the investment grade bond market with only a yield of 1%. That's not going to get us to our target. But it's had huge money flow year to date. 10 billion in, 1 year 14 billion. It got 10 billion of that since the sell-off. But that trade is not going to work. So we've got two things that may not work in traditional portfolios. The equity index is range bound and a bond market that will no longer benefit from systemically falling rates, which is what has actually occurred since 1981. That's going to reverse at some point. So we're talking about the medical dividend companies, the energy companies, and other selections. Real estate, the money flow has been essentially negative with the exception of April. Real estate appears to be in liquidation in anticipation of foreclosures and offices being downsized, if you will, for obvious reasons. Now, this is that trend in interest rates. The bond market benefited from rates falling 6% on the 10-year Treasury in 2000, and you could see rates would go up and boom, they'd go lower, go lower, go lower, go lower. Interest rates now less than 0.5% on a 10-year Treasury. No thank you, might as well be in cash, and cash rates are zero. There's going to be a trend next year. We got to see if the banks are going to actually start charging to hold cash, but at these low rates, it means money will look for another place. And bond holders like the Vanguard Total Bond Market are not going to benefit from systemically falling rates like we see in the last 20 years. That's a key diagnosis for portfolio construction. Now, this is just for fun. Brinker International, that's Chili's, Maggiano's, great chain, well run from here in Dallas. And you could see Brinker before the pandemic at about 48 bucks at the high. That thing hit a low of 7 in the shutdown, right? As restaurants understood. It already rebounded to $49.61, a new high. Some of that may have been a short covering rally, but we're going to see opportunities like that. This is not a recommendation for Brinker. It already went six-fold. But anyway, the Brinker International is a great example of trading strategies that we can implement with good companies that have good cash flow, good profits, and good dividends. And as we move into the recovery cycle and potentially have corrections, that's where a more proactive strategy can make the difference for you and your family and your retirement portfolio. Don't forget that cash flow will be king by this time next year based on 0% money markets and a 10-year treasury at a measly 0.4%. So the institutions are going to start looking for where to go other than the technology and other than the bond market, which is not going to work the way it has in the past. I'm Spencer McGowan, President, McGowanGroup, and your financial weatherman. Thank you for joining us and look forward to seeing you right here for next week's broadcast. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who are devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.